Breaking news today, the Federal Reserve has decided to drop interest rates by 0.5% or 50 basis points if you speak Fed language. What that means to you as a buyer and the housing market as a whole, stay tuned. Hi guys, this is Phoenix with Coldwell Banker Realty here in sunny Orange County. Today we're going to be talking about the Federal Reserve drop today. Great news. For the first time in 4 years, the Federal Reserve has dropped their interest rates down by 0.5% or 50 basis points, and that is a good thing. But let's talk about what the Federal Reserve is first before we get to homes and buyers and what it is not. So first of all, the Federal Reserve interest rate is not mortgage rates, right? They affect mortgage rates. They're correlated, but not the same thing. They're like cousins, but not twinsies, okay? So what that really means is that the federal interest rate is what banks get charged overnight by the government or the Federal Reserve to basically either stimulate the economy or to slow down the economy. And they'll want to do that. We just got off of the post-pandemic inflation phase of our last couple of years, and the feds were seeing that prices were getting too high, demand was outpacing the supply, and when supply is low and demand is high, the prices go up, right? And if it was in reverse, supply is too high and the demand is pretty low, that's when you see prices go down, right? And that may happen like in a recession. If people start losing their job, they don't want to buy stuff. And so the supply starts picking up and the prices usually drop to get people to buy stuff. That being said, the Fed in their infinite wisdom have decided that the inflation rate has gotten to about 2.5%, which is comfortably where they want to be. They want to get a little bit closer to 2%, but that's okay. It's going to fluctuate a little bit up and down anyway, and that's what it always does every month. So they're happy to start trying to bring that interest rate, borrowing rate, down to a more level place to keep the markets and the economy as a whole balanced and not supply or too much demand, right? In a nutshell, what does that mean for you? That means when the feds decrease their borrowing costs to banks, things get a whole lot cheaper for the bank, which means that trickles down to the consumer because things get a whole lot cheaper for the consumer to borrow money, such as for businesses, such as lines of credit, such as buying a car, such as buying a house. So that's how that plays out. Now, mortgage rates, like I said, are a little bit different animal. They are similar, but not the same. So with mortgage rates, usually it is tied up to a long-term 15-year, 30-year debt, because that's usually when people make how long they pay their mortgages. And so it's related more to the 10-year, 15-year, 30-year treasury notes, right? And so when we see those things start to fluctuate, that's when we see that the mortgage rates both increase or decrease. Also, depending on market conditions, such as, again, supply and demand. Usually it's more like the bank saying, hey, how many buyers are coming in to borrow money from us? We want to make a profit, so on and so forth, right? If it's up or down, they will make those adjustments accordingly. If it's too expensive or more expensive to borrow money, they're going to pass those costs on to the consumer. So that's why interest rates for homes have gone up as well as the Federal Reserve interest rate. And then we'll see, depending on inflation and credit risk for per person, then the credit risk could be that they're an A+ creditor, or they could be a very not so good creditor, and you might see if they can get qualified or not qualified, right? That does happen. Or if they're subpar but they're okay or medium range, then their interest rates might be a little bit higher than the prime rate or the perfect rate, was what that's also known as. So that being said, let's talk about, now that we've seen the rates from the Federal Reserve get lower, we have also seen bank rates for mortgages go down. Now, here's the funny thing. Did you know that rates have been dropping for over a month and a half now because the banks were already kind of factoring in that the Fed was going to drop rates in September. So rates went from the high in the beginning of the year to almost 8%, upper 7.88% for an average mortgage rate at the beginning of 2024. Now we're in September, and we've actually come down to 5.0 for a conventional loan, and even sorry, I'm saying that backwards. 6.0 for a conventional loan, and 5.8 for a first-time home buyer loan. And those are different because of the fact of who's backing them, and different story for a different day. But that being said, that's a good sign. We actually saw rates kind of in the sixes last week before they even dropped the rates, in the low sixes. We've seen them in the mid sixes at the the start of the month. We saw them coming down from 7 last month. So that's a really good sign across the board. Now that we've got that all established, let's say you want to buy a house at the remainder months of 2024 or into 2025 or so on and so forth after that point. Now, assuming that the market stays consistently the same going forward for at least the next year and a half, 2 years, then here's what that means as rates start to come back down. And before I even get there, the Federal Reserve has indicated that they will be dropping rates at least one more time in 2024 and quite possibly 2 more times in 2025. And that is a good thing for you as a buyer because number one, it means that you have more buying power. And let me illustrate that point here. You have a 10% return on your money for every 1% home mortgage interest rates decrease. So what that means is if you were going to buy a house, let's say for $500,000, and you decided to get an interest rate that maybe was at 1.6% and now it's come down to 5%, well, that means that you can now afford a $550,000 house. So that's a big win because that means that you're now in a different bracket of homes, right? Either bigger, better, more updated, better condition, better school district, better location, so on and so forth, depending on what you are looking for as a buyer. And as they say in real estate, it's always about location, 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 but it also is features and lifestyle and so on and so forth. So do factor those things in. But with a decrease in interest rates, that means that you can buy a bigger, better, badder house. Okay, and better meaning good. Number 2. That also means that you can also lower your payment. So let's go back to that $500,000 house. Let's say you decide not to do a $550,000 house, but just a $500,000 house. That means that your monthly payment has now decreased by 10%. So if you were going to buy something before with a 6% increase and now it's a 5% decrease of mortgage rates, that means that now you have a 10% decrease in overall monthly payments. Boom, win-win. Or you can find some happy medium between that. A little bit better house, a little less money, so on and so forth. All right, building equity quicker is number 3, and I want to explain this one to you. So when you buy a house, you have money that goes into that house. Some of the money that you pay for goes into a pool that pays off the money, not a physical pool, but just a pool of money that goes to the mortgage bank, right? And they take their little profit off and then they pay the house off, right? And what usually happens with mortgages is that they actually charge a lot more interest because the amount of the loan in the beginning half, as that starts clicking down, the interest rates, the interest kind of goes down on a monthly basis. So you have a lot of interest at first, and then you have a lot more house paid towards the back end of that loan. So if you don't have to pay as much interest, that means more money is going to that home month after month, and thus you have more instant equity built right into just paying off your loan on a normal basis, just like you would already. So the last thing is number 4 is market opportunity. Now, Federal Reserve dropped their rates today. It is September 18th, 18th, 2024. And that means that as those rates start coming down with mortgage rates, that means more buyers and sellers may start coming back to the market. So this is not a good thing if you are a buyer. It can be if you're going to move quick. But ultimately, what it means is, first of all, we should start seeing some freed inventory, because some inventory has been locked out, right? Because people have 2 and 3% interest rates, and they didn't want to change over to a 6% or a 7% interest rates. But when rates get back down to like maybe fives, we'll probably see more inventory coming to the market. And this is for people who don't have life issues such as divorce or new kids or new marriage, or like I said, parents, downsizing, right? They need to go to a smaller house or something else. So those are normal life factors, and that's going to be the normal as is. That's already been in play currently. But people who want to start buying and selling property again, once their loans start equaling to the house that they have, they'll start turning over that mortgage. So that means property is going to go up, but it's going to take a little bit of time. What's going to happen before that is buyers are going to start coming back into the market. And as of right now, that supply has not kept up with the demand. It's been relatively balanced for the last, I'd say, year, maybe year and a half. But we'll start seeing that increase in demand outpacing the supply here. And remember what I said earlier, that means prices will start going up for buyers. So that's not necessarily a good thing for buyers. It is a good thing if you're going to sell. So it is something to keep in mind. Just know that that's going to be a let's call it a uncomfortable situation for the next, I would say, 6 months to a year, until that gets kind of balanced out and we start seeing interest rates get back to a more normal place. Now, what is a normal place? Well, it's kind of hard to say because rates always are adjusting, but over the last couple of years, they've been really sitting on average in the 4% to 5% range, maybe even pushing into the upper or bottom, upper fives, maybe pushing in the sixes. And we're back there right now, but we'll probably see some decreases a little bit more than just a 6% in interest rate over the next, I'd say, 6 months to a year, year and a half. So act today. If you're looking to buy a house this year or early 2025, now's time to strike. Get the house, find the house, buy the house. And then when rates come back down a little bit more, you'll be able to refinance it. And you've got the house, you've got the lower interest rates. You don't have to wait for rates to get down to 4% again or 5%. I don't know where they're going to go. I'm just guessing, guys. So just know that you don't have to wait. Find the house, buy the house, then refinance. That's the smarter move here. So in conclusion, guys, 4 things you need to remember as mortgage rates decrease over the next, let's say, 4 to 6 months, 7 months. You're going to see an increase in buying power for buyers. That means you're going to be able to buy more house for less money. That means that your monthly payment, number 2, is going to be less than before as those rates start coming down. That also means that you're paying less money to that loan, so your equity will be increasing faster and faster, which is a good thing. That means you have more money to take away from that home later on as an investment. And markets are going to change. They're going to shift again. So we'll see an increase in buyers starting to come out the lower those rates come down. So my opinion to you is don't be an average buyer. Get out there, be an informed buyer, get out and rush out there and start looking now. Contact me. I'll be happy to help you. Find the right house and make a smart move. And then once we get that house closed and sold, you're moved in and the rates start coming down even more, you get to refinance without having to fight with a ton of other buyers out there in bidding wars again, because that will come. I promise you. That is my crystal ball telling me so. It's a formed decision because I've seen it before. We saw it the last couple of years. We really were sitting in a seller's market for a decade prior to COVID. So, and a little bit into COVID, and post, inflation, that's when it slowed down. So don't be an average buyer. Reach out to me today. Let's help you make a smart move. This is Phoenix again saying you guys have a blessed day. Let's start that housing journey together and enjoy the rest of your weekend. Bye-bye.